Hi, this is Nevin Williams. I'm a mortgage loan officer and a real estate investor. And today what I want to talk to you about are the benefits of a VA loan. So what are exactly the benefits? What makes the VA loan different than other loans? Well, first off, there's no mortgage insurance. So the VA does not require a down payment. The veteran who's eligible can purchase a home with no down payment. And most other loans are going to have some form of mortgage insurance, but the VA loan does not. Again, no down payment is also a benefit. But more importantly, and people don't realize this, is that the underwriting is really flexible on a VA home loan. Matter of fact, in the guidelines, it basically says at the very beginning that an underwriter needs to use flexibility in their underwriting of a VA loan and to use common sense and judgment, as well as, good underwriting. They can't just ignore things that could potentially cause a problem with the veteran not being able to make their payment. But whenever there's something that's going to benefit the veteran, they need to consider that as part of their underwriting criteria. It is the only loan program I know of that has that wording in the guidelines. The other thing that is important about the VA loan is that it's assumable. And assumable means, let's say for example, that I did a VA loan and my interest rate was 3%. That I did one back in 2020, 2021 when the rates were low, and I decided to sell my home. Well, if there's another eligible veteran that also has a VA benefit, instead of them having to take today's higher interest rates, they can assume my loan with that lower interest rate. Now they may have to come out of pocket for the difference, but the key is that the bulk of the money that they need to borrow could be at a very low interest rate because this loan is assumable. Now, conventional loans typically are not going to be assumable, and other loan types may or may not be assumable, but the VA loan is assumable. And my dad, who's a veteran, actually did an assumption. It was in 1972, 1973. Interest rates were really high, and he assumed a VA loan that was at 5.5%. So, living proof, we went through it. My dad had a VA assumable loan, and he saved a ton of money by assuming that VA mortgage. The other benefit is that the VA loan allows streamline refinancing. And streamline refinancing is basically just a loan modification. So let me give you the difference. If I had a conventional loan and I want to refinance, I have to get a property appraisal. I have to provide pay stubs, W-2s, bank statements, so basically income and asset documentation, and I have to go through the full process in order to replace my loan to do the refinance. With a VA Streamline, there's no appraisal, there's no income documentation. As a matter of fact, on the loan application, we leave the income portion blank. So you're not going to have all the paperwork that you have with the traditional refinance. So the Streamline Refinance is a great loan program for people wanting to lower their interest rate and payment, and they don't have to go through all the qualifying that they do on a normal loan. VA jumbo underwriting is so much easier than conventional or traditional jumbo underwriting. So I can't explain it, but the guidelines for a jumbo loan are very difficult. They require a lot, including lots of money in the bank, reserves as we call it, excellent credit scores, so on and so forth. With a VA high balance, as we call it, which is essentially VA jumbo, the underwriting criteria is much easier. So that, in my opinion, is a great benefit of having a VA loan. And so what does a VA do? What's their role in this whole thing? Well, essentially, a lender doesn't want to do a loan unless a buyer has a 20% down payment, because it puts the lender at risk. If the buyer stops making payments and the lender has to take the property to foreclosure, the lender can lose anywhere between 20 to 25% of the home's value in fees and expenses before they can get the house sold. Well, the VA essentially steps in and says, look, we're going to guarantee the loan against loss. We're going to guarantee it up to 25%. So if the veteran does a VA loan, they stop making payments, you have to come get the house, the VA is prepared to pay up to 25% guarantee. And so that's the VA's role. Also, the VA has created 18 chapters of guidelines that mortgage lenders have to follow. And as long as they follow those guidelines, the VA should guarantee that loan. Now, if you don't have a 10% or greater service-connected disability, the VA is going to charge the veteran a VA funding fee. And this VA funding fee is financed into the loan because they know that the veteran doesn't necessarily have that money, and that would totally negate the purpose of doing 0% down. So again, the VA funding fee is the way that the VA funds this program. But if the veteran has a 10% or greater service-connected disability, they don't have to pay the VA funding fee. I'm not going to tell you what the amount is because those amounts can change. But if you go to va.gov, you can go to va.gov, and the lender's handbook has all the guidelines there. Feel free to go through it if you want, or you can reach out to a loan officer that understands how to do VA loans. Thanks for your time.